Thank you, everyone, for inviting me here today. It's very surreal. I remember being in the audience just like you guys about 10 years ago, which is really dating me at this point. And to be a part of this tradition is just really an honor. And Rich, thank you for the service and impact that you've had on the community, past, present, and future. You've really changed my life. When I was here, I was a 20-something-year-old hothead going into business school, and I came out, I think, a better person, in terms of a contributor to society and just a better person in general. So I want to thank you for that because I'm sure everyone in my class feels the same. Now, one thing I want to preface this with is that while I've been working in this field for 4 years now, there's so much more that I don't know. And so the Haas principle of student always has actually lended itself very well to this space because we are in the early stages of the development of this technology, and there's simply so much to learn and to continue to learn. Now, what I'm going to share with you for the first 20 minutes before we kind of do a fireside chat are some of the points of view that I and my team have developed over the past few years about what this technology is, where this technology is going, and ultimately, what does it mean for people, humans, and society. Now, a little context on IDEO CoLab. It's a unit that I helped them start 3 years ago that looks at technology as opposed to humans first. So most of you know IDEO as a product and design firm that starts with humans at the center, right, to identify core human desires and needs, to identify new opportunities. What CoLab is, though, is it's a special unit of IDEO that starts with technology. And the thought there is that by starting with technology, we're looking at new capabilities to solve human problems and societal problems in completely new ways. We started with blockchain, and we've been expanding to other areas like artificial intelligence, augmented reality, and the like. Now, before I talk about blockchain, I want to share a quick video on a technology that's even more complicated than blockchain. Because if we can get that, then we can surely get this one, right?
Oh, that little mark with the A and then the ring around it?
At?
See, that's what I said. Kay said she thought it was about.
Yeah. Oh.
But I'd never heard it. I'd never heard it said. I'd always seen the mark, but never heard it said. And then it sounded stupid when I said it. Violence at NBC.
I heard around big fight up in the lunchroom the other week.
There it is. Violence at NBC. GE.com. I mean.
Well, Allison should know.
What is internet anyway?
Internet is that massive computer network, the one that's becoming really big now.
What do you mean? That's big. How does one? What do you write to it like mail?
No, a lot of people use it and communicate. I guess they can communicate with NBC writers and producers. Allison, can you explain what internet is?
Okay, that is one of my favorite videos. It's from 1994, and it's about the internet. Now, the funny thing about it is that it's not too dissimilar from the type of narrative and conversation that we're having today about blockchains and cryptocurrencies. People are super confused. It's actually, it requires mental gymnastics, and it's sometimes extremely frustrating. So you can send this, like, internet money that you make up anywhere around the world for, like, what reason? I don't understand. Well, to understand what is blockchain, because today it looks a lot different than it did 10 years ago, we have to actually rewind and look back to the context in which it was developed. For what reason, from a first principles basis, was blockchain created, and what problems was it trying to solve? Do you remember where you were 10 years ago? I was actually here on campus. I was starting my first year MBA. I entered to the business school in August 2008, and what happened a couple months later? This happened. Everyone remembers this, right? It was a really scary time. I remember job postings on CareerNet, going away by the day. Friends of mine and family members of mine lost their jobs, right? And we heard stories, many stories of people who were losing control over the thing that in some cases they cared about most, right? Money and assets that they had worked so hard to acquire and their families and their livelihoods were relying on, right? Now, what was the reason for that? Well, the reason was because there were a number of things. A lack of transparency in the financial system. It was very opaque. People were trading things that they didn't actually fundamentally own. And most importantly and emotionally, right, as I said, people didn't have control over their own assets, right? So it was very emotional and a very important moment in our history. Now, at the same time, what happened right around that same kind of timeline. Well, a person or persons by the name of Satoshi Nakamoto publishes a white paper on the internet called Bitcoin, a peer-to-peer digital currency. And what it imagined was a new type of financial system, right? One that didn't have the same properties of the one that led us to the financial crisis. It was, open, meaning anyone could participate in it. It was completely transparent, so you could see all transactions on the network. But perhaps most importantly, it pushed ownership to the edges of the network, meaning users had complete control over the digital assets that they owned on the network, in this case, Bitcoin, right? Which in that context of what was happening in 2008, extremely profound. Now, I got into the space in 2014, and I started looking into this technology and what people were saying about it. And what was interesting was you had some people on one side of the coast, saying that this thing was basically irrelevant and it was going to go away. But at the same time, you had people who had pioneered and invented the internet, saying on the opposite end of the coast that no, this was something that was going to be as important or even more important as the internet itself. And so coming into this space new, trying to reconcile two very intelligent and very important people's kind of views at the same time that were completely different was very confusing. Now, what's been interesting is how quickly that narrative has shifted. And so the question that it then poses is, what did people miss the first time around? And I'm going to summarize a few of those things. The first was that people were obsessed about the price. I mean, people still obsess about the price today. And in the early days, no one cared about it because they bought pizzas with it, like in 2011, which I'm sure you've heard about, how someone bought the equivalent of a $70 million pizza. Clearly, I was in the wrong business at the time. And over the years, right, as the price started to increase, people became more and more obsessed with the price. I mean, you can't go a day without reading about it in CNBC or the Financial Times, especially when it hit almost $20,000 in December of last year. Now it's back down to about $7,000, but still people are obsessively focused on the price. Now, despite kind of this story constantly changing, right, one story has remained fairly consistent, and that's adoption and growth of the network itself. So if you look at the number of transactions on the network over that same period of time, especially in the days when it crashed from $1,200 down to $175, network adoption has been growing fairly consistently, 3 to 5x over that same time period. And so what they missed was this kind of underlying utility of Bitcoin, which we now understand as the blockchain, right? It's this distributed ledger, and upon that distributed ledger, that can store many types of records. Currency is one type of record. Bitcoin is one of those. But there are other kinds of records that can be stored in this: assets, contracts, data, identity, those kinds of things. And upon those records, right, distributed or decentralized applications that utilize, manage, and update those records can now be re-architected in a pretty different way. When we were looking at this at the bank, this was one thing that I started looking into, which was if you look at the banking stack as a technology stack from the front office to the back office, right? Before the internet, most of this vertical stack was operated by one or a few parties. When the internet came around, though, it introduced this new channel and this new platform where a wave of fintech innovators could come in over the last decade or more, right? By streamlining the user experience, by improving sort of the product and the application itself. So companies like Square, PayPal, Venmo, Betterment, et cetera, have been really disrupting financial services in this way for the last decade. But when you look behind those companies or underneath them, many of them are still running on traditional banking rails, right? So when you move money over Venmo, to take it out of the system, it still requires Wells Fargo, JP Morgan, Citigroup in order to take money and cash it out of that application. So what blockchain introduces is disruption at the lowest level of the stack. It's really redistributing the architecture in a new way upon which all of these applications and services and solutions can be rebuilt. So it's very threatening to incumbents, but also presents a huge opportunity if you get ahead of it. The last thing that was missed was looking at the limitations of the technology in the early days as constraints and reasons why the technology would fail as opposed to key features of the system. So this is something that we looked at, at IDEO is thinking about what new properties or characteristics does this technology have. One was that it was fully open and it wasn't closed, unlike most financial systems today. It was distributed, not centralized. So while it makes certain trade-offs associated with throughput and like transaction speeds, it gains advantages in terms of not having central honeypots that are central points of failure that can be hacked. And the third and most important, especially in the context of the financial crisis, was that, again, it pushes ownership to the edges and gives users control over their data or assets. In a world where Facebook sells your data and commercializes that, you see things, you buy something on Amazon, and then the next thing you see is an ad for it on Facebook. This is becoming a more and more important issue as time goes on. The big kind of thing that that wraps this all together is that when people looked at the technology in the early days, they looked at it as a static thing, as if it were going to stay that way for the next multiple decades. Just like the internet didn't stop changing after the 1990s, right? Nor did Bitcoin, and nor did blockchain. It's continuing to evolve, and that's why it's so humbling, in a way, to be in this space, because it's constantly changing every single day. And so what I want to share with you is where is this going? Well, one of the ways in which to identify how it's constantly changing is to see the impact that it's having in other related markets. One thing that we've been tracking lately is how it's changing venture capital itself. So the top line there is early stage investments into tech companies through equity instruments. The bottom is equity investments into blockchain startups. What I'm sure many of you have heard of recently are ICO and token sales that are fundamentally kind of changing the way in which capital formation is happening. So a lot of early stage venture firms are starting to adapt their models to be able to invest in both equity instruments as well as crypto tokens, as some of these companies are raising seed rounds, A rounds, purely through the sale of cryptocurrencies. The other is company formation itself. So it's not just like the way in which they're capturing capital in order to build their company and whatever. We believe that these are fundamentally different types of companies. So if you look at this graph in terms of market value creation, it took 50 to 60 years for Walmart and McDonald's to reach $100 billion of valuation and market cap. It took about 20 to 30 years for Google, Amazon, Apple, and Microsoft to do that. Facebook in shorter time, Uber in shorter time, but these networks are achieving network values in 3 to 5 year time frames of 100 billion or more. And these, we believe, are just fundamentally different types of companies with different types of entrepreneurs, different needs, and different sort of growth trajectories. The other kind of third thing is that, I'm sure there's a lot of confusions with what these crypto tokens are. And as an investor, and also for regulators who I used to deal with all the time, this is even more of a problem and more confusing. They are often designed like commodities in that they are fixed unit and fungible. They're sold like securities, which often fits under the remit of the SEC. They operate in some ways like payment networks or systems, which operates under sort of regulatory, the regulatory body there is FinCEN. They provide, in some cases, utility-like software, and they are borderless like the internet. So what are these things? They're actually all of these things and none of them at the same time. So what does this all mean? Where is this technology going? What is it? Where is this really kind of like going in the future? Well, we talked about the internet in the very beginning, kind of as a humorous entry point into this. But this is kind of what the internet looks and feels like today, right? You have your private information being stolen. Equifax and companies like Target are being hacked. You have all of these all of this noise from an advertising perspective, being pushed to you on a daily basis. You have passwords and user logins that are not portable across services. And we believe. Oh, sorry about that. Not sure what button I pushed. So we believe that some of the core sort of design choices and protocols upon which the internet was built in the 1980s, 1990s are actually showing signs that they're starting to break, right? Honeypots, we already talked about that. The ads-based business model are leading to sort of, suboptimal outcomes. Walled gardens, where data exists in silos and prevent, services from collaborating or becoming interoperable. These kinds of things are core issues at the base protocol layer that can't be solved based on, how the internet is designed today. Now, with blockchains and cryptocurrencies, you now have this new sort of special power. You have digital proof, right? To be able to now say that I am who I say I am, I have what I say I have, and I did what I say I did. Like I said I would do, right? These are things that in a digital world were previously very difficult or impossible to mimic. And so what we believe is that the real kind of power of blockchain is this new system for incentive creation and alignment between developers, providers of infrastructure, users of that infrastructure, and investors. And this sort of virtuous cycle that is, in many ways, re-architecting infrastructure and how people participate and develop it. And so the big picture, if there's one kind of chart to leave you with, we see this not as in isolation, right? Bitcoin, blockchains in isolation, but as part of a multi-decade transformation of the internet itself. So in the early days, right, we've seen these cycles from decentralization to centralization. And, in the early stages of the internet, in the 1980s, 1990s, it was highly decentralized. And now over the last 5 to 10 years, we've started to see pretty massive amounts of centralization around, companies like Google, like Amazon, like Facebook. And that's creating some problems, right, for society and for people. And so Bitcoin is part of the early stages of a redistribution of the web and all of the products, services, businesses that were built on top of that. That's why we think that this is, a much more important and bigger movement. Eventually, we also believe that, it will ultimately re-centralize, but for at least a decade or more, we're going to see, many of these services that we know of today being re-architected in ways that, we couldn't previously imagine. And so this internet that we, live in today was all about sharing. We think that the internet of the future is about mass collaboration. And so what we're going to see are things and products and services that previously were really challenging to coordinate. Let me give you a perfect example of this, markets everywhere. So fundamentally, sort of blockchains enable participants to discover each other and align incentives to be able to coordinate the exchange of goods or services. This isn't going to enable P2P markets to pop up in places that we previously haven't seen before. And we're going to see many new things come about in these areas, and these are some of the areas that we've been prototyping and exploring and also investing in as part of IDEO Collab. And so what I'll just end with is that this quote from Kevin Kelly, that the coolest stuff hasn't been invented yet. And if I were you sort of in school at this time, I would be so excited to draw on resources that you have on campus, like blockchain at Berkeley, some of the amazing programs that we have at the master's and undergraduate levels, because today is the best time to begin building. And as far as like what to go build, he has this amazing quote, which is, create what the world wants to become. And so in this context of blockchains, cryptocurrencies, and the decentralized or distributed web, what is it that the world wants to become? Well, we go back to the original capabilities of blockchain, that it was more open, more distributed, and user-owned. This is what the world wants to become. It wants to become more accessible, it wants to become more transparent, and it wants to give people more control over the things that they own. So whether it's with one of these technologies or not, this is where the world is going, and I strongly invite you and encourage you to come be a part of building that future. Thank you.
Thank you for that. You know, I appreciate your mentioning blockchain at Berkeley. This is another of the remarkable student-driven networks that grows up at Berkeley. Whenever anything remarkable happens in the world, the students are way out front of the faculty and staff. And it is just a remarkably agile network that includes the business school, the law school, electrical engineering, computer science, right? The whole, it's really quite remarkable. It's as close to a kind of frictionless and boundaryless a network as you can imagine. And we were just talking to Lauren, and she was mentioning that, you know, some of the young people that are in this network on campus who came from 2 or 3 years of experience in the markets, there are companies that are inviting our undergraduates to come talk to them about blockchain. It's kind of like, you know, the reverse mentoring idea, but it's sort of like these young people are so much closer to some of this stuff than any of us are. So that's, I just want to call out blockchain at Berkeley as sort of one element of how things are moving very, very fast around here. And we have many faculty that are teaching in this area and exec ed and other things that you've helped us with. So I want to start by thanking you, not just for being here today, but for helping us build that capability here at Berkeley. You've been helping us on many, many fronts, so thank you for that. Let's get into some conversation. Now, I want to take us back to the starting point, if I could. You used the term distributed ledger, and anybody who's in business school knows what a ledger is, right? Ledgers is, okay, it's kind of a transaction lens, right? We're keeping records of transactions. Then you also talked about personal data. And you talked about other things. I remember that one slide where you had blockchain as the foundation, and then you had sort of data and transactions and other things on top of that. So whenever I define the word blockchain, you've defined it perfectly correctly, but I usually always just start, it's a database. It's a database. Now, if we want to think about it as a record of transactions or assets, then I think calling it a distributed ledger is a perfectly simple way to talk about it. But that is, in fact, a refinement of a much more generalized idea. It is a database, and one that we can trust in the sense that we haven't gone into very deeply here. But if I could just give you, look, I know zero about cryptography or you know, the deep technical stuff. But there is one thing I needed to learn to teach my class, and I just want to communicate it to you, because I think it's helpful for understanding, well, that's interesting, because an application leaps out from it. Now, if you've read anything in this area, you've read about what a hashing function is, and you probably have no idea what a hashing function is. But let me give you an example. You can go to my hard disk on my computer over here. You can pull off a 10-page document, Word, PDF, whatever, okay? Just pull off a 10-page document. It's a bunch of zeros and ones. That's what it is. We have something called a hashing function, and let's just call it hashing function number 1. Every computer has access to hashing function number 1. Hashing function number 1 is just a bunch of mathematical relationships. You don't need to worry about it. But if you take my file from my computer and you pass it through hashing function number 1, whether you do it in Worcester Hall or you do it over in electrical engineering and computer science, you do it at IDEO, whatever, that file put through hashing function number 1 creates a series, 256-digit-long series of zeros and ones. Now, if we take my file off of my computer and I change a 4 to a 5 on page 7 or an A to a B on page 9, and we pass it through hashing function number 1, we do not get the same sequence of zeros and ones. Now, that's interesting. You can't look at that different sequence of zeros and ones and say, oh, you changed a 4 to a 5 or you changed to an A to a B. That you can't do, but that's not important. Why is this relevant, that we can all know that a file is sort of the right one? So imagine, most of you have hired people from universities. You hire somebody from a university, you do a background check. It's a pain to have to figure out whether somebody actually got a degree from Berkeley. I mean, for a lot, you have to have like a stamped transcript. It's not easy to verify somebody has a degree from Berkeley. So now Berkeley creates a PDF, says this has all the people that have ever graduated from Berkeley, their names and their degrees, and when you put it through hashing function number 1, here are the zeros and ones that you get. Now somebody says, I'm applying for a job, I got my degree at Berkeley. Sort of like, can you show me a file that has your name on it and the degree? Here's the file. I'm going to pass it through hashing function number 1. Do I get this sequence of zeros and ones? If I don't, I will not accept it. If I do, I believe you got your degree from Berkeley. Now that's pretty profound. Because if you had a database that we all agreed on of who owned the art in 1945, or who owns what property, think title insurance, sort of like now we have a database that we agree on that's permanent. That's profound. And I haven't even mentioned finance, right? So it's a database, and it's a generalized ledger. Anyways, I just wanted that simple idea. Take a file, put it through a hashing function. You can tell whether a single 0 or 1 in that database has been changed, because it will give you a different output on the other side of the hashing function. That's fundamental to understanding what's going on here. All right. Now, getting more into what you said, which is really the guts of it, but I think it's really helpful for people to demystify certain parts of this. So you could see why that would be a really easy way for Berkeley to communicate who has degrees and who doesn't. Or if you said, you know, you talked about private sort of history data, right? Sort of like you create a CV. Well, you could have verifiable contents of your CV that's very easy for anybody to verify if you wanted to do it that way, right? Okay. Let's go into, I want a couple of the really big ideas. I'm going to jump back to the big ideas. There are so many things, and I know you have questions, but let me go back to this idea of needing intention. This idea that this is evolving very fast. It's going in lots of different directions. It's going in directions that people don't much like at a societal level. It's going in directions that people like very much at a societal level. And so as a matter of sort of, it's a hard question, but in terms of kind of what we as society want, what does intentionality look like? Is it going to be a company by company thing? Do we need to get public policy involved? What does needs intention mean we should do?
Yeah, I mean, this is a big reason why IDEO is so adamant about taking a leadership role in the development of important technologies like this. Not just this one, but also things like artificial intelligence, because if you look at other technologies that have changed the world, internet, mobile, social media, right? They present amazing opportunities for society, for humanity, for people, but they also lead to unintended consequences. And we live in that world today with things like fake news, cyberbullying, all these things going on with social media. And so blockchain technology, we call it distributed web technologies, present that same opportunity, potentially even greater than that, because now it starts to impact the core of some of the architecture or infrastructure that are at the foundations of society, like money and assets and things like that. And so because this presents such a huge opportunity to, in many ways, re-architect society and re-architect businesses, it's super important that people from all disciplines, designers included, come in to design these technologies in a way that actually help unlock those opportunities, help improve society and improve things for people. Because left to their own devices, technologies will do what they're agnostic to, political belief or humanity even. And so that's why we, as designers, are really stepping into this, because they have to be. This technology, among others, is screaming for design and putting humans at the center of that. And so what I think, talking about Berkeley for a second, why I think Berkeley's so well positioned and it's so important that Berkeley leads in spaces like these is that, bringing in a multidisciplinary approach, public policy, law, finance, economics, the business school, the computer science school, into these like kind of grand challenges, as you say, is ultimately important to make sure that they don't create a monster that we can't end up controlling years from now.
Mm-hmm. And that phrase, I love the phrase re-architecting society. I know this is an unanswerable question, but the wonderful clip from 1994, and the internet has transformed so much, right? It really has transformed so much. And then if we thought if we said the internet is a 10, I think a lot of people, well, blockchain isn't a 0 or a 1. People keep telling me it's more transformational than that. It might be a 5 or a 6 or a 7. But when we start talking about re-architecting society, and to some degree the internet has enabled this and has already done some of that, but are there scenarios where you feel like blockchain and this kind of self-controlled identity and some of these elements of what make, that blockchain could be greater than 10? Is this a crazy idea?
I would say that it's somewhere probably between a 7 to 10,
okay.
Or maybe even more. I mean, let me give you some examples. For example, like the banking system itself, right? There are approximately 2 billion people in the world that don't have access to basic financial services. And, when you actually unpack why that's the case, it's not because, banks aren't there. It's actually at the base level, records associated with identity, which is the foundation of credit, don't exist. And so, as one pointed example, the ability of some of these distributed systems, basically distributed architecture or infrastructure, to reach some of these edges of society, to provide them with identity, which some people would argue is a human right, and establish the foundations of credit to lift them out of poverty and other things, is hugely transformational in ways that existing models like putting a retail branch or giving mobile devices to people in rural Africa simply could not alone. And so we see huge. I've seen huge opportunities like that to reach to make certain services more accessible to people that previously could not tap into these things.
Great example.
And so I think that this technology presents a unique opportunity to do that. The question is, whether or not humans, i.e. us, will actually design it in a way to achieve that, promise or impact.
No, I love that example. I was mentioning to you that the foundation for Ripple Works, is interested. We've been discussing a conference on blockchain for good. Right, and there are all kinds of brand new applications in many areas that are developing. I was visiting an alumni chapter in London just within the last month, and the daughter of one of our alums there, who had been working on refugees in Calais, France, was talking about how important it was for a lot of these refugees, right, to establish bona fide refugee status is very difficult when you don't have any identity or anything else. And that blockchain could become a really important part of how to address the refugee problem. And that was what she was working on. I thought, well, that is really interesting. And, it's like daily we hear these new applications. And so many of your slides were great at sort of showing here's the big frame, and we haven't even begun to paint the insides of it yet, right? So that's great. I want to make sure there's time for questions here, because I know this audience is very, very interested. I come at this a little bit more from economics, right? So one of the questions that I address in my class is, what are the fundamentals of cryptocurrency, right? What's the fundamental value of the euro? That's something we have a lot of theory on, and we have a lot of empirical work on. What's the fundamental value of Ethereum? These are the sorts of things that I think about. But they're probably not the most interesting things for you. So instead of asking questions like that, why don't we leave it to the audience? Now, we're going to need you to use the microphones. If there are no questions, I will keep going. But please, if you'd use the microphone on the side there. There's one just, you'll have to stand up and walk to the side. Sorry about that. And then, thank you. We're doing a video for our video room, so it's helpful to have the questions. Please.
Hi, my name is Niba Agarwal. I'm also an alum. And actually, my question is probably a continuation of Dean Lyons' question. I am curious because on your charts, you showed that there's a cryptocurrency for transaction pricing, for putting and accessing ledgers and the records. My question is that lately, especially in technology and in healthcare, we are seeing that people are actually charging real dollars instead of cryptocurrency. What do you think what is going to happen to transaction pricing, and how do you value it? How do you put a price on it? Because it's not cryptocurrency anymore. So again, it goes down to what is the fundamental value of a euro. So now it's not just crypto anymore. It's, crossing paths with dollars, and there are different entities and different industries accessing it. So there's no standard coin, if you will, that is, making sure you're using it. So how do you account for that? So that's my question. And what should the transaction pricing be?
And that's a very big question, right? This
is the question we are struggling with right now.
Yeah,
so.
It's a very good question, and it's a very big question.
Yeah, I mean, I think the simplest way to answer that is that as long as the system, whether it's blockchain or otherwise, creates a efficient marketplace, right? The marketplace will define what the transfer price or transaction price should be. Now, in a crypto kind of like world, right, those marketplaces or markets aren't always efficient. Because to move from, like, for example, Bitcoin to Ether to the US dollar to the euro, like, there's a lot of transaction costs associated with that. So some of the things that are happening right now in the space are, for example, the introduction of fiat-pegged cryptocurrencies, like cryptocurrencies that are pegged to the dollar or the USD. The USD or the euro, that enable those transactions that kind of look like real-world transactions, just with like real fiat dollars. The introduction of things like price stablecoins. So that's a huge area of research right now, and some like Maker and others that are starting to push prototypes into live production and in the world.
Can you explain price stable?
Yeah, a price stablecoin. So part of the problem with using cryptocurrencies as the primary way to settle transactions is the fact that if you use Bitcoin to buy a good from you or something, within an hour or something, the price could go up or down by hundreds of dollars or large percentage points. And because of that price volatility, it will prevent people or systems or applications or whatever from using price volatile cryptocurrencies as the primary means of transacting. So as a response, there have been a number of teams that have started what are called price stablecoins, where they will either through the business model or algorithmically keep the price of their coin stable or pegged to some index or something, like maybe it's the US dollar or something else, to just make that coin a better transfer of value.
Yeah.
So fiat pegged cryptocurrencies are one, price stablecoins are another, and then frankly, some of these systems. It's a question of whether you do things what's called on or off chain. So on chain meaning using a cryptocurrency, or maybe it's just handled off chain, meaning you will transfer the ownership of the asset or data or something like that, but then execute the payment through traditional means. And so depending on where you are in the ecosystem, like especially corporations that are pretty hesitant to use cryptocurrencies as a primary mode of payment, using kind of an on-off chain setup is where a lot of these companies are going, healthcare, financial services included.
Yeah, I'll just add a little bit. So I'm an economist. I'm an international economist, and I work in exchange rate economics, right? So you might think I'd have something to say about this. But when we think about fiat currencies, when you think about what is a money, right? A money, this is Econ 1. It satisfies three needs. It is a medium of exchange, it is a store of value, and it is a unit of account. You may remember that, foggy as it is, from Econ 1. And so when we think about the roles, is a cryptocurrency a money, and is it a fiat currency, meaning that there's no fundamental value? It's not backed by anything, right? The dollar is not, dollar's a fiat currency. One of the things that you worry about in an emerging market currency, for example, is that you worry about the supply side. I'm an economist. You want to think about the demand side and the supply side. When the supply side is pinned down by physics, as is the case with Bitcoin, that there can only be 21 million of them, and there's a 22 or whatever the number, that's interesting, because if you want me to be confident in the supply side of an emerging market central bank that's not very independent, that's hard to be confident in. I'd rather be confident in physics. But that's just the supply side of Bitcoin. Where does the demand side come from? Well, that's really interesting. And I'm using reverse mentors in this area as well. I had breakfast with my nephew. He's in his mid-20s. And I said, it's not backed by anything, right? He said, man, you just aren't getting it here, right? He said, He said, I can go out and buy 100 shares of IBM stock. I can put them on a blockchain and issue tokens for them. So if you own one of these tokens, there's 100 tokens. We can call the token whatever we want. It's a new kind of currency. 1 unit of this currency entitles you to the full ownership value of 1 IBM share, including the dividends. So it's backed by IBM, and it's like safe. Nobody can take it. Think of it as like being held in escrow. So that puts a floor on the value of the currency. You wouldn't expect it to fall any further than that. It could go up above that, but that's no longer a fiat currency. So when Venezuela says we're going to create a petroleum-backed cryptocurrency, right? It's sort of like if you had oil and it was in a safe place and you could get to it, right, then a petroleum-backed currency might be pretty interesting. But if somebody just says we got a lot of reserves, you should be confident in our currency, it's sort of like that's not backed by petroleum, right? So anyways, the degree to which these assets are truly backed, it varies enormously from one initial coin offering to another, and even from Bitcoin to Ethereum. But at the end of the day, you've got to go through the same kind of logic, sort of what does the supply side look like, what does the demand side look like, and so forth. I don't know which of you two was first. Sorry. Do you know? Okay, go for it.
Hi, my name is Alex Prosser. I'm a full-time MBA student here at Haas. And I'm super curious to know which other industries do you think will be disrupted by blockchain and cryptocurrencies? And which industries that will not be disrupted, that in your view, blockchain does not suit so well? Yeah,
that's, I mean, a really interesting and also hard question to answer. I mean, I think that what is clear is that, you know, based on where blockchain and specifically Bitcoin was started, it will have the biggest impact in financial services, without a doubt. Now, what has been interesting, and we do a lot of work in the IDEO Collab with this, is that we've been working across, various companies and industries. So we have, car companies that are interested in this, healthcare companies, aerospace, manufacturing, energy, and the like. And so I think that, one of the things that I felt when I was at Citigroup was that what is fintech really, actually? I mean, you see a lot of companies these days, Google, Samsung, others, creating fintech, businesses or products. And so I think that any one or any industry that, has a fintech or financial services component, which is basically anything, because all businesses involve payments or transactions of some kind, at least have that part of their kind of like operations or business to be potentially reinvented with this technology. Whether or not it ultimately will impact sort of like the, secondary or tertiary kind of like areas of business around like data management and things like that is I think still to be determined. But where I think this technology, going back to your point about this being a ledger, I mean, it's going to be most useful when that ledger is recording some kind of data or asset with, some amount of financial value. Because that is really kind of like the core, unique purpose of this enabling technology.
And I think that just a very small point to add to that is that we often think of blockchain, and the notion of chain is, remember I said that there's this 10-page document, right? It's like, okay, so as soon as more people graduate from Berkeley, you need to add to the document, right? That's the chain part. You add a little bit, and then you create a new document, and everybody knows what the sequence of zeros and ones out of that document is. So it's the new official document. But we often think of that in a transactions way, or as an economist, in terms of flows, right? But the stocks matter too, right? And the stock, when we think about income statement versus balance sheet information, right? Who owns the assets at a given point in time? Who owned the art in 1945? I think we want to think about both kind of balance sheet and income statement or stock and flow dimensions of what blockchains can do for us. Please.
I'm a MFE student. My name's Alex. I kind of have a question for you, Dean Lyons. I'm wondering, what do you think the implication of having 10 to 40% of a currency owned by single individuals is? Because I know Ripple, the founder, owns about 30 to 40% of the asset. Bitcoin, presumably Satoshi owns something like 10%. What do you think that, in a traditional, macroeconomic sense, says about the currency's future and the demand between people?
Well, it's a great question. I think that it's at least at the level of national currencies, which is normally the way we think about currencies, right? It's very, very rare that any private citizen would have anywhere near that kind of a fraction, right? But we will readily go out and purchase shares in an IPO that the owner still owns, 30 or 40% of, or the founder does, right? So we know that there are asset classes that we enter into when you have massively concentrated ownership. There's a lockup period after an IPO, but it's like 6 months. So you're walking right into a somewhat similar situation, that there could be one decision maker that controls, 30% potentially of the asset. So while that's quite rare in the currency asset class, it's not that rare in IPOs and other asset classes. And given that it's not that rare in other asset classes and we seem to manage it pretty well, I think just the fact of that being true need not be worrying on its face. You just have to ask the next question about, okay, is this different than an IPO, and that kind of question.
One thing that we look into a lot is, with a lot of these companies that are having token issuances, kind of very much like stocks, is what is the distribution of that? And if, founder teams or whatever are keeping a majority of those tokens, it presents, in some ways it's similar to, how companies form today, but also it also presents new risks or risks associated with like manipulation of, their token economy. So it's something that, investors are very, intent on looking at.
Exactly right. Yeah, please.
Hi, my name is Tom, and I'm also a current MFE student here at Haas. I have a question for Ian about the technological side of the blockchain technology. So as you've mentioned, blockchain, you can see it as a distributive, decentralized database. And with the possibility that, nowadays thousands of companies can issue their tokens as well, and everything goes on blockchain. And at the same time, all these transactions happening globally simultaneously at the same time, does it pose a sort of a pressure or threat to the efficiency of the calculation? As we all know that, the clearing frequency of Bitcoin is 30 minutes, and Litecoin tried to tackle that problem by shortening the clearing speed to 1/5 of that, or maybe 1/6. I can't remember exactly the number. But it doesn't fundamentally solve the problem, if there is one, about the efficiency of recording every single transaction in the world on one blockchain or several. If there is a solution, what do you think there is?
I'm just going to jump in real fast. This is your question, but we had 2 people waiting here and 1 behind him. So we're going to do 3 more questions after this. We're going to do them quick, and then we're going to have to call it. Go for it.
Sure. So super quick. I'll address that in 2 ways. One is that the community, meaning the developer community, are addressing this through, solving the scaling problem, which is what you're describing. So the introduction of things like new consensus models, like proof of stake and various other things, introduction of state channels and various like payment channels or things like the Lightning Network. Those are hopefully going to increase the throughput and capacity of some of these, networks, these blockchain networks, to support more transactions at a faster rate. That, however, in my view, is nice but not sufficient for solving the bigger problem. And the way that problem, I think, ultimately gets addressed at a macro level is not looking at these things in monolithic terms, meaning a blockchain to kind of like rule them all, or one blockchain to do everything, but purpose-built networks for specific use cases. And importantly, as those purpose-built networks emerge, interoperability between those things. That's ultimately, I think,
there's a certain level of optimization. You would say that can bring in and help the development of that model or that network.
Yeah, I mean it's optimization of existing networks and being more
connectivity between
connectivity between purpose-built networks, I think, is ultimately where this is going.
Thanks for that question. We'll have to jump over here. Yep.
Hi, my name is Arvin. I'm a undergrad student here at Haas, and I was wondering, what are some of like the concrete steps that you envision, either like technical, economic, or political, that would need to be taken in order to create like a scalable blockchain infrastructure? that could be adopted like en masse by a bunch of industries?
That's a good question. If I knew the answer to that, I would be focused on that. I mean, I think that one of the biggest things that needs to be solved soon is how traditional regulatory and legal frameworks view this thing. I think that in part because there's so much uncertainty and confusion around, is this thing a security? Are these, monies? Are they software? It's actually, in some ways, stifling innovation and the progress of this technology and ecosystem. So I think that what's super important is bringing in, many disciplines and parts of society to start to answer that question. And once that's answered, then I think that it's off to the races in terms of building out this next generation infrastructure. I mean, yes, there are technology issues and various other things that people are already working on, but that I think is one of the biggest things that no one's really looking at collectively right now.
Thanks for that. Thanks for the question. Yep. Please.
Hi, my name is Jane Gao. I'm a senior at Haas. So in your presentation, you linked this technology, this blockchain technology, with human desire, which I found very interesting. So you said humans want to have more control over their data, want the system to be more decentralized. However, you also mentioned that this technology requires a lot of designers to come and build the infrastructure. So it seems like it gives the builders or the designers or the first adapters a lot of power over the way humans or other users can utilize or experiment with this new technology. So could you maybe clarify that a little bit? Because that kind of is a little bit conflicting in my opinion.
What is the conflicting piece?
So the conflicting piece is it is a decentralized technology. It gives user the ability, or it gives user the control over the data. However, it also requires a lot of designers to come in to build this infrastructure that allows the users to experiment the data. So I find that piece kind of confusing. Could you clarify that?
I guess, and I'm not sure if I'm understanding, but the point that I was trying to make is that blockchain products and services, or crypto products and services, look as different as mobile to web to non-internet-based products and services. And so the design of them and the user experience are totally different. Even answering the question of why does someone want a blockchain network? Why does someone want something to be decentralized in the first place? A lot of times, actually, we don't care. We don't really care that it's decentralized versus centralized. So those types of questions are questions that, for example, designers are. It's very important for them to help answer as these things are being created, because, as I'm sure many of you know, a lot of these projects out there haven't answered those kind of first principle questions, and therefore, maybe aren't needed actually, which is driving some of the the market sort of crash that we're seeing right now. And so I think just to kind of summarize, it's really around identifying what people want and why people want it.
And providing that in a fairly decentralized way, right?
Yeah, and
so the makers, the coders are quite decentralized.
Yeah, and organizationally how that works, a lot of these teams are virtual. They're not in one place. But the reason that designers are needed is because, at least in our view, it helps answer the question of why is a decentralized product valuable or useful or desired by people.
Thanks for that. Thanks for the question. Please, last question.
Hi, good afternoon. My name is Mark Parker. I'm an evening weekend MBA. I just want to say thank you, both of you, for spending the time to talk to us. Questions probably for Ian a bit, but just you touched on this a second ago around regulation. And I think when you look across just blockchain technologies as well as cryptocurrencies, when you look across those technologies, how do you see government regulation playing a role in actually impeding our ability to see widespread adoption, not just within financial institutions, but globally?
Well, maybe I'll jump in first. I mean, I think regulation both impedes and accelerates. That's the nature of regulation. When you think about, is anti-money laundering regulation just a massive impedance? yeah, it impedes some things. But man, you wouldn't want to be trading with a lot of institutions that didn't have to pay any attention to anti-money laundering, in my view. There are a lot of people that feel like the wild, wild west of the initial coin offering world is a little too wild, wild west for them, right? Just isn't enough disclosure. There aren't enough rules of the game. I just have no idea what I'm buying. There's too much fraud. I can't participate. If there's a little bit of oversight, a lot of people say I'm much more likely to play. So that's regulation as an accelerant. There's obviously the regulation as a friction, right, as a decelerant story. But a lot of people start with regulation as a decelerant. And in fact, there's no such thing as laissez-faire capitalism. Rules of the game allow us to operate in markets. Frictionless, perfectly functioning markets actually don't exist. And you can point to any industry, and if somebody can make the argument that zero regulation would make that industry better off, nobody's arguing that, at least nobody that I think is credible. So I think the part of the question is, how do you design something that doesn't impede? Because a lot of things impede unintentionally, and I think that's what we're trying to figure out here.
Yeah, I mean, I completely agree in that the purpose of regulation is actually to protect society in many ways, like protect, negative consequences from happening from, these like, dramatically accelerating technologies. And so I think to Rich's point, the most important thing is for regulators to actually become knowledgeable, catch up, and design regulation in a way that accelerates and promotes sort of this technology in a way that unlocks the benefits for society as opposed to, impedes it. And, the further kind of compounding problem as it relates to this space is, as I mentioned earlier, is that this technology is inherently borderless. So one of the unique challenges of this is that, how one regulator views this in one jurisdiction, has implications on other jurisdictions in ways that, you don't see with, other kinds of financial instruments or products or whatnot.
And I think what's exciting here too is that there will always be a completely unregulated dark part, in my view, of this market. And I think one of the stunning things is just whatever your view of what and how Bitcoin is being used, I think one of the surprises is there are a lot of people that really, really, really care about privacy. And a lot of people who live in the world that I do would say, you have the dollar and the euro, you have these totally almost frictionless currencies that you can trade at. There's no need for a new currency. We've already spanned the space. We've met every need. But every currency that looks like the euro and the dollar, you have to trade through a banking institution, et cetera. And a lot of people said, no, this thing over here, this currency over here, is a different category. And some of those are for black market transactions, but some of those are people who just have a very high value on privacy. And you got to respect that at some level, right? And I think that's part of the surprise. It's like that, and you wouldn't want to regulate. I think you wouldn't want to regulate that away. I mean, at least so I see a kind of tiering. There's going to be parts that are overseen and regulated, and some people are going to want to participate in that part, and others aren't. But we're going to have a big continuum, and we're going to run a bunch of experiments. So, Ian, look, you've taught me a lot in several conversations that I've had with you. I think I just want to laud the students one more time, Lauren and everybody. They've just accelerated the whole campus in catching up with this stuff. You can never really catch up with it. It's moving too fast. But I love the fact that our agility as an educational institution comes in such an interesting way from the students and what they're doing and what they're helping us do. And, some of the things that you pointed to, this needing intentionality, right? This is going to go to some important places. And just assuming it's going to go there in exactly the right way is way too bold an assumption, right? And so what does that look like without getting too heavy-handed in constraining things? And then, this self-controlled identity just is another very big comment that you made, right? We all know this. We've especially know this over the last few months, right? I mean, there's just a lot of our identity that hangs out there. And for some of us, that's not a problem at all, and for some of it's a profound problem. But I think for most of us, it feels like, whatever your view, it feels like it's a bigger problem than it felt like a year ago. I think that's safe to say for most of us. So the idea that controlling a little bit more of our data in the future, in the internet or electronic marketplace, I think most of us are going to want to run our own personal experiments on whether that makes sense or not, and that's part of what this technology will enable. Ian, thank you for being here. We appreciate it very much.